Welcome, investors. I think it's finally time for the markets to accept interest rates are going to remain higher for longer. We had a handful of Fed officials speak on the topic this week, and we're going to take a look at a few of them and see what they said. S&P 500 breaks new all-time highs, reaching that $5,000 mark. Is this going to continue? And why is it happening? We're going to discuss it. So we had a handful of Fed officials speak this week, just like I said. Let's get into it. So I'll put a couple articles on your screen here. So the first one, Fed Mester warns against cutting interest rates too soon and too quickly. Cleveland Fed president says that she may be confident enough in falling inflation to ease policy later this year. Let's take a look at the Fed Kashkari. Inflation isn't all the way there to the Fed's 2% goal. Rate cuts can wait. Fed rate hikes probably not the main reason for the slowdown in inflation. Interesting. Fed's Goolsbee, nothing needs to change in the data to justify rate cuts. The U.S. economy just needs more data like it's been getting in recent months, Chicago Fed president says. All right, you heard it from them. They're going to keep rates higher for longer, likely not going to get a rate cut here in March as the markets were expecting a couple weeks ago. And the reason for that is they are going to err on the side of caution. If they cut rates too soon and then we have a spike of inflation, then we have to do this battle against inflation all over again. And it could be worse, it's going to last longer, so they don't want to they want to get this right once because it's a longer process to fight inflation again. If they tighten too much and then draw us in a downturn, they have the tools to turn that downturn around. Granted, there will be pain, there will be more job losses, but they can cut rates too. They can bring rates down. They can start purchasing assets on the open market, which brings up asset prices because it lowers the supply and demand. That brings the economy out of a downturn, cutting rates, printing more money, being ease on the money supply, allowing money to flow in the system, allowing for companies, businesses, consumers to gain credit, to be able to go and spend, which juices up the economy. So that's an easier fight for them instead of fighting another prolonged period of inflation. I mean, we've been fighting inflation since early 2022. So they don't want nearly going on 2 years now. They don't want to repeat another 2 years with this inflation fight. So that's what we can expect. May, June time frame for these begin the rate cuts. But they are going to want to see it in the data. They're going to want to see weakness likely in the economy, and that's going to further drive down inflation. And Fed Kashkari said something that it's not just the Fed rate hikes cooling down inflation. There's supply chain issues that are easing. Really, those eased a year ago. It's not still, we're not still dealing with supply chain issues from COVID, even though they use that as an excuse. I mean, there's always politics at play. That we need to understand that when it comes with any of these press conferences or any of these political figures speak. So we just need to understand that. So Kashkari was saying is, it's supply chain, it's interest rate, not just interest rate cuts, but the economy is slowing down. And then when the economy slows down, demand slows down, thereby slowing down inflation. All right, let's move on to our next topic. S&P 500 breaks that $5,000 mark, and we're making all-time highs. The markets are looking strong right now. Well, it depends on what markets we're looking at. If you're looking at the biggest companies, the Amazons, the Googles, the Meta, the Apples, the Microsofts, yes, they're making new highs. But when you shift over to, which make up the S&P 500, they make up the majority of it. But when we look at the smaller companies, you heard of something called the Russell 2000. Those are the companies that are not mature. They may not be generating a profit yet. They're in advanced growth mode, and they don't have a lot of cash. They don't have market caps where, when I say market caps, they don't have the customers all over the world like the Apples. They're smaller businesses, but they make up the majority of businesses in the United States and the world, the smaller businesses. You look at, for example, the Russell 2000, it is still down between 10 and 20% from their all-time high, where the S&P 500 made up of 7 companies, the Magnificent Seven is making all-time highs. So there's a big difference in the economy, what's doing well and what's not doing well. But we need to understand, since the S&P 500 is made up of, and the stock market is made up of these really large companies, Why are they performing so well compared to the smaller companies? And I think there's a big theme that we need to understand is they have more ability to lower their expenses, to lower their costs, whereas these smaller businesses that maybe have 5 employees to 150 employees, they don't have as much room to cut costs. Their margins are much more tight. Let me show you something here. You have this article here talking about Google, Microsoft, Meta, and other tech companies continue job cuts in 2024, laid off more than 32,000 employees so far. Tech layoffs full steam ahead in 2024. In total, 2,001 companies cut a total of 428,836 workers in 2023. That's at 1,175 per day. Here's the list of the companies that laid off so far in 2024. Xerox, 3,075, Envision, 500, Amazon, Audible, 5% of workforce, SolarEdge, 900 staff. You have Vroom, e-commerce, auto, 800 staff, 90% of workforce. Snap, 528 staff, 10% of workforce. So you're seeing these companies, and it's interesting. So they're laying off workforce, they're laying off staff, and it's a lot showing up in the earnings. Earnings are still showing strong because they're laying off a lot of costs. So their earnings look good. Their earnings per share, because they no longer have the same amount of expenses, and they're maintaining the revenue where it is right now. And the revenues have been declining as the Fed tightened rates. It did come down, and now they're cutting costs to keep their earnings strong. So we're seeing this transition period where we had weakening earnings, a lot of retention of staff. Now we're seeing, still not as strong of earnings that we had in 2021. We're still seeing this revenue slow down. Things are slowing down, but they're cutting costs. They're getting rid of staff. So that means their profits, their net profits are higher. So net profits, revenue minus expenses equals profits. And when you're lowering expenses, your profit margin remains higher. So that's what we're seeing right now. We're seeing these big businesses lay off staff, and it's keeping their profits and their earnings higher. And it's reflected in the stock market. So they have what we can call fat to get rid of to keep their business stronger. That's why the S&P 500 is breaking all-time highs. Your smaller businesses, not so much, significantly falling behind the major companies. They have the ability to lay off workers. So I think it's an important thing to keep an eye on is, are they going to keep laying off staff? When does that transition? The staff, who are consumers, they're employees, they're going to go out and spend in the economy, which transitions to smaller business earnings. Smaller businesses are buying from these large businesses. Consumers are buying from these larger businesses. It's going to start to reflect in these larger businesses at some point if the slowdown continues. And will the slowdown continue is the question. And will it significantly materialize, or will we come out of it with the said soft landing? Those, I think, will start to reveal themselves over the next course of 1 to 6 months here. I think we'll really see it and have a really good understanding by June, July timeframe. But I think we're going to start to see it. We'll start to see it show up in the data more and more as more layoffs happen, and those people with the lost jobs can no longer expend at the same capacity that they did prior to. And, okay, one other point that I wanted to highlight before we wrap this up and talk about what's going to happen next week, which is a very important week. It's a data point that was released this week. Let's take a quick look. So I got this Market Watch article which shows you the data. Actuals in this column, the forecast by the economists and analysts in that next column. Consumer credit forecasted at $15 billion. We got $1.5 billion. That's a big number. We'll talk about consumer credit in a second. Consumers slammed the brakes on borrowing in December. Fed data shows U.S. consumer increased by a slight $1.5 billion after $23.4 billion in November. Now, what the heck does that mean? That means consumers are taking on less credit to spend. So two things could possibly be happening. Number one, consumers are tapped out with credit and can no longer obtain credit from banks, from banking institutions, financial institutions for their credit cards. So when they can't obtain credit, that means they're tapped out with their savings and they can no longer spend. That's why I said we may see this in the next couple months, that the slowdown continue because consumers can't get credit. Or what is happening is consumers don't need the credit. They're stacked with savings and are going to continue on their spending habits because everything is good. Now, the two possibilities have very different ramifications. The first one, we're going to continue to see a slowdown because consumers can't spend, or is it the second one where the consumers are flush with savings, we're going to keep seeing them spending, and we're going to have that soft landing as the street and what the majority of economists and analysts will call it consensus believe, the soft landing. Time is going to tell us. We have another inflation report next week, CPI. It's going to be for January. Do we start to see January continue to slow down with that inflation trend coming down? So stay with us. We'll be on top of it for you. Expertise you deserve, experience you can count on.